The country is at a critical stage in its transition to economic recovery, the leader of Japan's largest trade union stated with the optimism today. Employees will enjoy the largest wage increase in the last 33 years. The Bank of Japan signals its intention to complete its 8-year policy of negative interest rates. Meanwhile, in the United States, hotter than expected inflation has adjusted forecasts for when and how often the Federal Reserve will lower its interest rates. Bank of America, for example, predicts total rate cuts by 0.75%. The first stage is likely to begin in June. Importantly, market forecasts are gradually changing to more and more hawkish ones. That's now most market participants reckon that the regulator will implement even less than 3 rate cuts in 2024. For comparison, 2 weeks ago, the consensus allowed for 3 and 4 rate cuts, but at the end of last year, they speculated about 7 rounds of monetary easing. It seems that the market has admitted the fact that there will be no rate cuts in the United States in the first half of the year. However, traders remain cautious ahead of the Fed's policy decision. For this reason, the stock market declined in the light of the data on retail sales and inflation. Wall Street closed in the red on a Thursday. The odds are that the S&P 500 will trade on a Friday without much volatility in the intraday corridor between 5,123 and 5,177. The US dollar could show its best week since January on a Friday, following yesterday's rally. The greenback is trading steadily higher against the basket of 6 major currencies within the intraday corridor between 103.30 and 103.50. The euro this week was hit by a double whammy: the hawkish Federal Reserve and soft comments from the ECB policymakers. The official rhetoric expressed by Christine Lagarde at a press conference after the policy meeting was for a rate cut in June. However, recently her colleague François de Gallo admitted that a reduction in interest rates could occur as early as April. Bank of Austria Governor Robert Holzmann advocated for a rate cut in June on a Wednesday, and his colleague Yanis Stournaros supported the first rate cut this spring on a Thursday. Besides, on a Thursday, ECB Vice Governor Luis de Guindos said that the regulator should have sufficient information in June to begin making decisions on a monetary policy. The same point of view is shared by another ECB board member, Klaas Noot. To sum up, we count 4 advocates for the June rate cut and only 2 for the April one. Interestingly, despite the differences, all ECB policymakers remain dovish compared to the hawks from the Federal Reserve. Before the currency market again preferred the US dollar, the euro-dollar pair tried to consolidate around the levels of yesterday on the back of a rapid advance of the US currency, and the bullish trajectory for the American currency was slightly spoiled by a report on a consumer sentiment published today. However, data on industrial production in the United States again encouraged dollar bulls. As a result, the euro-dollar pair is trading with a high volatility within the intraday corridor between 1.0875 and 1.0903. However, at the moment, there are signs that the euro is oversold, so the instrument remains below the resistance level of 1.0900. If the bulls are able to stabilize the price above this critical level, the euro might begin its recovery at the end of the week. However, the euro's recovery looks problematic on the back of the US dollar released today. For example, a report on industrial production in the United States looked an uptick of 0.1% in February from a month ago after 2 consecutive months of decline. The University of Michigan reported that its consumer sentiment index dropped 76.5 in March to the lowest level in 3 months. As for oil prices, they fell on the back of some profit taken after a rapid rally this week. Besides, the sudden and significant strengthening of the US dollar also put pressure on oil prices. On the other hand, oddly enough, oil is supported by the same factors on which the American currency is growing. After all, consumer demand in the United States is growing, along with its retail sales, and fuel prices are also on the rise. But inventories of both crude oil and fuel are going down. This combination of market factors threatens to lead to local shortages, which will result in explosive price increases. Now we can already say that the stagnation cycle within the range of $81 and $84 for the Brent benchmark has most likely come to an end. Brent crude has already risen to the levels of early November last year. That indicates the process of a recovery relative to the previous decline. Meanwhile, technical indicators signal that oil is currently overbought, and this indicates only a temporary pullback, but not a change in trading interests. You have watched the market review by InstaForex analyst for Friday, March 15. Subscribe to InstaForex TV channel and we keep you updated on all market developments. Don't miss our videos. Your feedback is appreciated. Have a nice weekend.